This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Welcome to Bloomberg Businessweek Daily. I'm Carol Massar, along with Tim Stenovec, live here at Bloomberg headquarters in New York City. We got actually stocks up across the board, and we've got kind of, though, if you look at the S&P 500, Tim, an even split of gainers and decliners.
Yeah, we're going to have more from Charlie Pellet in just a minute. Tech stocks rallying today. The NASDAQ Composite up close to 1%. We'll get a full update in just a few minutes.
Yeah, some definite outperformance there. We'll get into that. Also this week, keep in mind we get key readings on both the U.S. labor and inflation scene. So we're going to get into that in just a moment. Also this hour, we are pulling out our crystal balls. Yes, we have one. No, we don't. But we're going to look into the future of U.S. Treasuries and the Fed. There's a couple of stories among our most read on the Bloomberg, which is why we are doing this. We'll get to that in a moment.
Also, Stuart Kaiser is stopping by. He's head of U.S. equity trading strategy over at Citi. He's going to talk a little bit about what we're looking at as the market's tug of war.
Yeah, looking forward to that. Also, we have been dying to catch up with our Madison Muller. She covers the GLP-1 space. There's a lot going on. She's going to weigh in on Novo's lawsuit against Hims and Hers Health, which was one of the folks that you could see in the Super Bowl ads. There was a lot of GLP-1 related ads, along with a lot of ads. Where else were there a lot of ads?
AI.
That was the other one.
That's a little tease for what's going on.
You know what wasn't so prominent front and center? Crypto.
There was a Coinbase ad. Yeah, there was a Coinbase ad. Okay. Also, Amy Rubenstein is going to be joining us. Opportunities in distressed real estate. She's a CEO over at Clear Investment Group. She's coming up in just a few minutes.
All right, folks, let's get to it. Let's get a check on the trading scene. Here is Charlie Pellet. Hey, Charlie.
Thank you very much. Well, hello there, and happy post-Super Bowl Monday. We've got the Dow fluctuating between gains and losses. A choppy session, at least on the Dow. Higher right now, we begin there, looking at a gain of 4 points. Any advance today will be another record on the Dow. Right now, trading at 50,120. S&P up 35, gain there of 0.5%. We've got NASDAQ up right now by 1%. The NASDAQ 100 index up 0.8%. The Russell 2000 index of small cap shares up 0.7%. All of this with the VIX holding just above 17. The 10-year 4.20% with the 2-year 3.48%. Spot gold up $98 the ounce, 5,063. Spot gold now up by 2%. Silver doing a lot better, up 6.7%. 83.06 on silver. West Texas Intermediate crude up 1.4%. 64.45 the barrel on WTI. And Bitcoin down 0.6%. 70,271 on Bitcoin. Converse employees have been instructed to work from home this week as the Nike-owned brand makes what's described as strategic changes in order to recapture sales. Novo Nordisk suing Hims and Hers Health for making knockoffs of its obesity medicines, even as Hims scraps plans to sell a copycat version of the Wegovy pill. Madison Muller will have a whole lot more on that topic coming up right here on Bloomberg Businessweek Daily. As for the shares of those two companies, right now we do have Novo Nordisk trading higher by 3.8%. Hims, though, Hims and Hers Health hit hard today, down by 17.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I can't help but feel it's like that, hey, stay home. We're going to have some announcement has replaced the, hey, can I see you first thing Monday morning?
How do you get all your stuff back?
I'm not making, I shouldn't, connect the dots here, but it just feels like we are seeing that more frequently.
There's an economic angle to that.
There is, and that's where we want to go right now. Thank you very much for that, Tim. Hey, let's get to one of the most read stories on the Bloomberg today. Former Fed governor and President Trump's pick to be the next Fed chair. We're talking about Kevin Warsh. Floated plenty of ideas ideas for how he would run the Federal Reserve during his campaign for the job as chair. For Wall Street, few are as cryptic or potentially consequential as his call, Tim, for a new accord with the Treasury Department.
Yeah, with what you need to know and why the U.S. bond market may find it unsettling, let's bring in Bloomberg Economics U.S. and Canada economist Stuart Paul. He joins us here in the studio. So Kevin Warsh has voiced support for overhauling the relationship between the two institutions, a new version of an agreement that goes back, all the way to 1951. We've had guests on who agree that perhaps the Fed has overreached its actions. Can you explain a bit these fears that investors have?
The primary fear that investors have is that monetary policy is going to end up completely playing second fiddle to fiscal policy, and the Fed itself is going to become an institution that just monetizes the national debt, sparking an inflation spiral. That's really the fear. And if we...
How does that logistically work? Explain that for those, perhaps Tim and me.
the Treasury auctions, the Treasury and the Congress run massive deficits. They finance that deficit with bond issuance. Those bonds are auctioned into the private market, and they know that they can rely on the Fed to just continually and perpetually soak up those bonds from the private market, thereby monetizing the debt. The Fed is printing money, putting it into banks' balance sheet as it pulls bonds out of the private market to just hold them in custody on its balance sheet. That's the major fear, right? By buying up all those bonds in perpetuity and putting reserves and just cash into the real economy, the bank is monetizing the debt and thereby stokes inflation. That's the big fear.
So you have a constant buyer, essentially, for treasuries. And
That's
so
right.
if you have someone creating demand for U.S. treasuries, it brings down rates, which makes servicing the debt cheaper.
Well, it makes servicing the debt cheaper as long as you don't actually get that inflation.
Right.
The Fed can only do so much to keep rates low through its bond buying. And if you end up attempting to monetize the debt too much, inflation expectations rise, and so do long-term interest rates, thereby making the cost of servicing the debt
More
over the long
expensive.
run more expensive. So there's been this separation in general between the Fed as the monetary policy agent and the Treasury, the fiscal agent. And the two are considered to be independent of one another. The Fed in particular has been politically independent of the Treasury Department. And that typically delivers low and steady inflation and better economic outcomes. Any sort of questioning of that relationship brings into question that political independence, brings into question inflation expectations.
But central banks have different roles in different countries, and the U.S. central bank has this dual mandate. Are you saying that there are concerns that that dual mandate will not come under attack, but it won't necessarily be viewed as those being the priorities of the Fed?
It's not so much a question of the dual mandate coming into question. It's really just whether the Fed is able to pursue any mandate separate from political involvement, separate from electoral politics. And as it has pursued its dual mandate, it has done so typically rather politically independently. And so we've had persistently low inflation up until COVID. And the big question around COVID is, Treasury issued a ton of bonds so that they could issue checks directly to people.
Right.
The Fed monetized it during massive quantitative easing. That if we were to have that sort of an arrangement, that would be very troubling.
So...
But we also know, I should say, also know that, yes, there's this relationship that's being reconsidered because the Fed has previously overreached. But we also know that Kevin Warsh, the one thing that he has been very consistent about through time is that he does want the Fed to have a smaller balance sheet.
Well, that's what
you can't do both.
That's what I don't understand. I thought that was his driving force. So I was trying to kind of connect the dots between that. I thought he wanted a smaller balance sheet. And we've had a fair amount of guests come on from, I think, from the business community as well as those who follow the Fed or the economy saying, yeah, maybe the Fed has outreach. So there are those who agree. So what is he doing?
So you have a bunch of questions regarding political overreach on one hand, the Fed considering things like climate policy and pressuring banks into lending less to energy companies. That could be considered politicization of the Fed and overreach by the monetary policy agent. On the other hand, you have Kevin Warsh's view that as a market participant, the Fed should be shrinking its balance sheet. It should not be monetizing the debt. When we have any sort of reconsideration of who plays what role in American society, the Fed or the Treasury, I think that Kevin Warsh and Scott Besson probably agree that the Fed should stay out of concerns related to climate policy and things of that nature. And I think they lean towards the Fed shrinking its balance sheet. I think that there should be less concern in markets that the Fed would be around to just persistently and perpetually monetize the national debt.
Unless there's a crisis or something.
We've seen it before. Yeah.
We've seen this before. But it does. So then, which one are we supposed to believe? That he wants the balance sheet to shrink, or he's thinking of reconfiguring the relationship, a new accord between the Treasury Department and the Fed?
Any sort of discussion of a new accord is a little bit curious and a little bit troubling, but I think that the one thing that's been very consistent through time has been that he wants to shrink the balance sheet. I think it's easier said than done, but I do think, and maybe this is just the optimist in me, thinking that the Fed will remain rather politically independent. It will not just be a sink for Treasury issuance, just holding those bonds inert, and that the Fed will remain politically independent.
Which he knows a little bit about, having served as a Fed governor already. Thanks for laying it out for us. Really, really appreciate it. Our own Stuart Paul joining us there. He is, of course, U.S. and Canada economist at Bloomberg Economics right here in studio. Tim, what's interesting is this comes on a day where, and we're going to talk about this with our next guest, what Stuart just laid out, but also we had China weighing in too about, not wanting their investors, I guess retail investors, not to basically buy U.S. treasuries. They are advising the nation's financial institutions to rein in their holdings of U.S. government bonds due to concerns over market volatility. So it's interesting, once again, kind of the pushback on what is a very important asset and financial instrument here in the United States.
Yeah, on that China story, officials urged banks to limit purchases of U.S. government bonds and instructed those with high exposure to pare down their positions. The directive, though, does not apply to China's state holdings of U.S. treasuries. And this move, Carol, framed around diversifying market risk rather than anything to do with geopolitical maneuvering or a fundamental loss of confidence in U.S. creditworthiness.
Yeah, it makes me think about this idea and this argument that the U.S. is increasingly becoming uninvestable. But let's see what Stuart Kaiser has to say about all this. He's head of equity trading strategy over at Citi. He joins us here in studio. Stuart, good to have you here. Welcome back.
Thank you. Good to be here.
Hey, we were just talking with our Stuart Paul about Kevin Warsh's past support of a new accord between the Treasury and the Fed, and this has to do with the balance sheet, which sounds like increased cooperation. We know in the past that Kevin Warsh has wanted the Fed to shrink its balance sheet. So we're trying to make sense of what it is. And then we just talked about the Chinese regulators advising their financial institutions to rein in the holding of U.S. government bonds. Are treasuries undergoing a reboot, in your view, on the world stage when it comes to the United States being kind of a sure thing, if you will, in the financial world? And if so, what are the implications of that?
I mean, look, I don't know if there's any real alternative for a lot of these, countries to invest their reserves.
Because of the size and the liquidity, right?
Exactly.
Of the U.S., like hands down.
And look, there is a risk out there in the long end of the government bond curves, I think, but that's globally. We've seen that happen in UK gilts. We've seen that happen in German bonds. We've seen it happen in Japanese JGBs. So I don't think really concern about the impact of fiscal spending on the long end of the yield curve is unique to the U.S., nor is it something that's kind of snuck up on people. But it is a risk. And if you look at what has triggered those kind of events in other countries, it's generally been things related to fiscal policy, tax cuts, things of that nature. So it's something that's on our radar. It's probably been on our radar since about last July, when all of those 30-year bonds globally got above 3%. As an equity guy, I'm going to let the bond markets tell me, when and if this becomes a risk. But for now,
but the equity guys keep a watch on the bond market.
we do, but I would say if an equity guy knows when the bond auction is, you're in trouble. But big picture, in this case, I think we have not seen the long end of the curve move significantly. We haven't seen bond volatility increase materially either. Sure. So for now, people seem pretty comfortable with things.
Well, speaking of the equity side of things, you were plenty busy last week with the rotation that we saw, the volatility that we saw, the moves down, then the moves up, a week that sort of ended really close to where it started, but a lot happened in between with some big moves lower when it comes to companies like software. What is your view on where to be optimistic right now and where to stay away from?
Yeah, I mean, so we're still pretty positive U.S. equity risks in general. We've been pretty bullish on the cyclical parts of the equity market since the beginning of the year. I think if you took a little bit of a step back, though, you'd see that this quote-unquote rotation sort of out of tech and growth and into value and cyclicals actually started back in November. It's not a new phenomenon. What happened last week is the moves accelerated and it got quite volatile. And I think that impacted the way that folks manage risk. And it's also, to be honest with you, a pretty simple math question, right? If you take the Mag 7 plus Broadcom and a few others, you pretty quickly get close to about 50% of S&P market cap.
Right.
So when you're selling those stocks, you have to find a home for them. And I think just the absolute size of the moves is really what concerned people last week, rather than a change to like the underlying U.S. equity outlook. I mean, U.S. GDP, according to the Fed, is tracking kind of mid 4% range. Our economic surprise index is kind of off the chart. Earnings were solid. You're expecting some good tax refunds coming up. So the sort of fundamental underpinnings of the market look pretty good. What you're going through is some indigestion after 2 years of buying tech and growth stocks. You're now kind of repositioning not whether you want to own U.S. equities, but how. And that process has been a little bumpy, to say the least.
Well, we talked too about the overperformance or performance of small caps last week. They were up about 2.2%, certainly outperforming the large cap indices. The other thing is, if you look at the equal weight S&P, it is easily outperforming the S&P 500, 5.5% year to date for the equal weight to just under 2% for the widely quoted S&P 500. So again, that plays into what you're saying, that we're seeing money go elsewhere. But what's to stop the money going back to big cap tech or those hyperscalers? Because it feels like the last 2 or 3 years, everyone's like, no, time to diversify. And yet, that's where the overperformance has been, or outperformance.
I mean, I think back in sort of October and November earnings season, you started to see a little bit of a change in this reaction function. Meta back then was the key one, where they announced this very large CapEx spending program and the stock sold off.
Right.
And that was probably the first time in the last couple of years where a company had been punished for spending more on AI. And look, lo and behold, this quarter we saw that repeat with a number of companies. So,
but Meta did well, right, off of their earnings, because they're showing the ROI on this AI spend.
They are, and that's the key, right? This CapEx spending is undergoing an audit or some other form of very invasive examination. But Microsoft and Amazon were both kind of punished for more CapEx spending this quarter. So I think what you're really seeing is within the tech trade, the shift has moved kind of away from the spenders and to the beneficiaries of that spending. We like power generation and the AI data center build out as the way to express that. And then more broadly, to your point, you're also getting a little bit of a rotation out of growth into these cyclicals. So again, these things aren't necessarily negative for the market collectively, but they do cause a lot of pain in some positions that people have had in their portfolios for 24 months minimum.
Alphabet embarks on a global bond spree to fund record spending, borrowing far and wide to finance unprecedented spending plan on its AI ambitions. $20 billion, a US dollar bond offering on Monday, more than $15 billion than initially expected. Is this a signal of something?
I mean, it's a signal.
Same thing you're just talking about.
It's a signal that they have a lot of spending to do. I think,
They also have a lot of money.
They do, but Amazon though looks like negative free cash flow after their announcement. So I think what folks are doing is you can generally carve out the Mag 7 and say their balance sheets are so big and strong that they can sustain the spending. They're all AA rated or better. You take a step, even a slight step down in credit rating to, let's say, an Oracle that's BBB,
right?
And that examination is a little more harsh. So I think what you're seeing from Google, frankly, is look, they're viewed as the current winner in the AI trade. Now, clearly, those winners are changing quarter to quarter. So I think folks are maybe a little more comfortable with them spending, because to your point, they have the ROI, they currently have the best AI model. If you can demonstrate an acceptable return on the investment, the markets are okay with this. If it looks like it's going to be ROE destructive, then right now you're getting punished for that a little bit. And I wouldn't expect that to change as this year goes on. I mean, there's a higher bar right now for what you're going to spend this money on.
All right, great stuff. Stuart, thank you so much. Really appreciate it.
Thank you. Have a good one.
Yeah, you too. Stuart Kaiser, head of equity trading strategy over at Citi, right here in our studio.
You think the equity guy's going to come back after we made him spend half the time talking about bonds? Hopefully.
I just know everybody watches everything.
Hopefully. He's always welcome.
He is, indeed. Hey, we were talking about maybe the potential for some things to get pummeled. We are seeing shares of Hims and Hers Health tanking to the lowest since late 2024. We'll explain why when we come back.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, Russell 2000 index, all advancing. S&P right now up 43. That is a gain of 0.6%. The Dow trading at a record. Any advance today will be a new high on the Dow. 50,158 where we stand. That is a gain right now on the Dow of 0.1%. Keeping it all in context, we got the S&P up 0.6%. NASDAQ Composite Index doing a little bit better, up 1% now. NASDAQ 100 Index up 0.9. And the Bloomberg Mag 7 Index enjoying a gain of 1.3%. The VIX just ticking below 17 now, with the 10-year at 4.19%, the 2-year 3.48%. Spot gold up $102 the ounce, up 2%, 5,066. Silver at 83.12 the ounce, up 6.8%, and an advance for crude up 1.3%. WTI 64.40 for a barrel of WTI. Bitcoin down 0.3%, 70,467 on Bitcoin. Eli Lilly has agreed to buy closely held U.S. biotech Orna Therapeutics for up to $2.4 billion in cash. Its second deal in as many days as the company expands its pipeline beyond its well-known blockbuster obesity drug Zepbound. Lilly shares down today by 0.7%. Recapping, S&P up 43 right now at 69.76. That is a gain of 0.6. The Dow at a record up by about 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, a lot of Monday morning quarterbacking when it comes to the Super Bowl. Like, we're talking about a lot of things, right?
Yeah, look.
You didn't watch all of it.
I did not watch all of it. Do you know how late that went?
I did. I watched all of it.
Yeah,
I like football.
We watched the first half.
All right. Well, anyway, Monday morning quarterback on the big game, on Big Bunny's halftime show, and yes, on the commercials. We've been talking about it in the newsroom. On that, there were several spots during the Super Bowl from the world of GLP-1 drugs, and that included one from Hims and Hers Health.
Rich people live longer. All that money doesn't just buy more stuff. It buys more time. The wealth gap is a health gap. The rich have health care that comes to them. Custom formulated peptides, specialists on call, and preventative care before they need it. They get the best of everything. So why don't you?
Yes, why don't you? That, of course, from Hims and Hers Health during the Super Bowl. Making these drugs more accessible has really amped up the competitive landscape for the makers and sellers of these drugs. We are definitely seeing that a lot.
Yeah. Just this morning, Novo Nordisk said it's suing Hims and Hers Health for making knockoffs of its obesity medicine, even as Hims scrap plans to sell a copycat version of the Wegovy pill. With a rundown on the latest headlines and sizing up the competitive landscape on GLP-1s. Our guru, Bloomberg News health reporter Madison Muller, joins us here in the studio. I just want to start with the lawsuit because I was pretty surprised last week when we got the news that they were going to do this, because I thought there was no more. It wasn't legally allowed by the FDA to compound, for companies to compound medicine anymore. Not any medicine, but GLP-1s, because there's no longer a shortage. Wasn't that the loophole that these companies were using?
Exactly. So it was a big, kind of a risky bet that Hims was taking, that the FDA just wouldn't do anything about it. But that is sort of what we've seen happen the last couple of years since the shortage ended. There's been really very little action from the FDA in terms of cracking down on this proliferation of compounded GLP-1 drugs. And so Hims has continued doing it. A lot of other companies have continued
So they're
doing
breaking
it.
the law by doing it.
That is the assumption, yes.
Okay.
But the problem is that the FDA really hasn't said much of anything. So it was kind of up to these companies to interpret the law themselves. So in this gray area, they've continued doing it. And that's part of the problem, is that it was a little bit unclear, at least to maybe the general public or to some people, what the FDA was really going to do. And so they've just continued to do it. Some companies have pulled back, like Roe, for example, stopped compounding after the shortages ended, and Hims has kept doing it. And so far, until now, there has been really little action either from Novo, from the FDA, and finally, I think both of them said enough is enough.
All right, so Novo files this lawsuit. All right, so I guess it's going to play out in the courts, or there's going to be negotiating, or what?
We don't really know.
Or does the FDA have to come in here and make a ruling to figure out what the real ruler law is.
Right. So Novo is suing on the grounds of patent infringement, which is something we haven't seen before. Novo and Lilly have both filed lawsuits against compounding pharmacies, telehealth companies, med spas that are selling these knockoff versions of the drugs, but they haven't gone after anyone for patent infringement yet. So this is actually the drug semaglutide, which is the active ingredient in both Ozempic and Wegovy. Novo is saying that Hims is violating that patent in the United States. So that's a big deal. That's a big escalation, and it sort of shows the more aggressive strategy that Novo is taking, because they really are under a lot of pressure right now.
Why are they under pressure and Eli Lilly's not as under much pressure? Much pressure.
I mean, Novo. So,
and we're going to talk about some deal news a little later, but
yeah. Novo, they've had different problems. Even though the market, they're the only two players really in this market. Novo has had more difficulty because, one, their drugs are a little bit older, meaning that they do come off of patent outside of the U.S. sooner, whereas Lilly has another decade of patent life on its drugs. Novo also has had more difficulties with these compounders because it did not get a handle on the supply shortage as soon as Lilly did. So both companies' drugs were in short supply. Novo had more issues, couldn't get a handle on it. Lilly got a handle on it more quickly and was more aggressive, really right off the bat going after these compounders. Whereas Novo sort of, they're Danish, they're a little bit less aggressive, I think, than an American pharmaceutical company, but they've had to change that recently. And then in terms of next generation drugs, their pipeline is not quite as exciting as Lilly's, and so that doesn't set them up for the future quite as well either.
I am shocked that we're already talking about maybe a move towards generics or their patents coming off. When did they start? I feel like it was just a few years ago.
Right. That's the thing. So Novo's drug Ozempic was approved, I think, in 2017, launched in 2018.
Oh, okay.
And so that's the same drug technically as Wegovy. Wegovy's just a higher dose version of that. So that was the thing. It didn't really come onto the scene. People didn't start talking about it until a couple of years ago, but really the drug's been around for a while, and so the clock has been ticking in that time.
Should we talk about the Eli Lilly deal?
Yeah, let's do that.
Okay, so this is not a non-GLP-1 deal, which kind of speaks to the idea of these companies diversifying. The company agreeing to buy the closely held U.S. biotech Orna Therapeutics up to $2.4 billion in cash. Second deal in as many days as the country looked to expand its pipeline beyond Zepbound. What does this do?
This drug, was that bound or this
no,
deal?
Deal? It kind of speaks to this idea of going beyond.
Yes.
Of going beyond this industry.
Because I kind of thought they were going to be living off this.
So did I.
For a long time.
But I guess that's why we're not running a drug company.
That's exactly why we're not. That's why we're here.
I had the same reaction as you did. I thought they got it.
They're going to tweak it. Yeah. They're going to make a pill. They're going to just kind of keep going.
Well, Lilly has learned the hard way that resting on your laurels, which is sort of the problem that Novo is facing right now, doesn't work. Drug companies should always be looking toward the next big thing because patents expire. And that's the problem with, the drug industry is you always have to be thinking about the next thing. Lilly is the one that brought Prozac to the market back in the 1990s. That was a massive drug. And for a while, Lilly was in a similar position where it was riding high on the Prozac fortune. And then after that, they really were so ultra focused on we're going to be a company that develops neuropsychiatric drugs and for psychiatric conditions, whatever, this is what we're going to do. And then they didn't have a second act to follow it up. And so I've talked to the executives at Lilly who have said they're really being purposeful about we have to be thinking outside of just obesity. They're looking at immunology, cancer, genetic medicines. A third of their portfolio is gene therapies now. So they're still extremely focused on obesity, and they're testing drugs for basically everything in the obesity landscape, from 5% weight loss to 30% weight loss. They want to have something for everyone, but they're also looking outside of obesity, and that's a really important part of their strategy.
Can I ask you something, going back to, because Novo's going to come off patent sooner. So should we assume that, so then there'll be all these copycats, that folks that maybe were taking Zepbound or something, we've talked with you that they're not all the same, that they're just going to run to, the generics because they'll be cheaper, or they're not going to be able to medically because things are different. Not every drug is the same.
They hypothetically would be able to. In consulting with their doctor, if their doctor's generic semaglutide is fine for you, sure, that's great. If that's the most affordable option, that's what your insurance covers. But we also have this other side of this industry where there's a huge cash pay component. And the drug makers, Novo and Lilly, have both worked with the Trump administration to bring down prices for patients in Medicare and also cash pay prices. And I think it's something like a third of patients in this market in general right now, in the US at least, are cash pay patients. So they're not going through insurance and they're paying these lower discounted prices that the drug makers offer through direct-to-consumer websites. And so the prices have come down much, much faster than we would normally see in such an ultra-competitive market. Usually that it doesn't happen this way. So patients maybe are already used to paying $200 a month for their Zepbound and they don't want to switch because that's what works for them, even though there's a cheaper option on the market. It's sort of a question mark as to what happens next.
So we're talking about this in the context of the way that Americans have are looking for ways to lose weight. We'd be remiss if we didn't talk about some of the messaging in the Super Bowl last night. Mike Tyson ad from, it was like a Maha ad out there talking about how processed food kills, and he's eating an apple at the end, and he talks about his own struggle, his sister's struggle. Is there any, I mean, I know it's kind of a crazy question, but is there any chance that the messaging with that starts to work and it attacks the problem that some argue is where it starts, right? This idea that we're not necessarily eating healthy, and therefore there won't be as much of a demand for these drugs moving forward.
I mean, it would be great if I think like everyone hopes, even Lilly and Novo say that they hope that people will eat healthier, move more. Like they say that that's an important part of these drugs too. But I think it's hard because obesity is a disease, and that's the message that these drug makers are also putting out, is that like this is a thing that for some people eating healthy doesn't fix. And even if you eat healthy, exercise, whatever, for some people that just doesn't, they have a certain genetic makeup, or it's whatever, like they can't lose weight, or it's really, really difficult for them to lose weight. So I think it's like not an either or situation. Both things should be happening, and hopefully both things will help bring down the obesity rates in this country. But
I wanted to ask you, because I feel like when we started talking with you that we, were like, this is the drug that's going to solve everything. Can these drug makers get initial indications for the medications that expands their patents or something? Like does that help?
I mean, it helps with getting more insurance companies to cover it, so to pay for it. There are some things, like if you have a different formulation for the drug, like those types of things. Sometimes pediatric indications will help give you a couple more years of patent life, but at the same time, it's like the clock is always ticking. It's not going to add much at this point, and you have patents, at least for semaglutide, for Ozempic and Wegovy, falling sort of all over the world within the next year, and so you will have those generics out there in the world, even if the U.S. patent hasn't expired yet. It's kind of only a matter of time before we get there.
I almost feel sorry. Like I know with like the R&D that goes into this stuff, like you kind of understand that argument. Having a brother that used to be in pharma, like we used to talk about this all the time, but
Right. And that's what I think they're also, like, they've really had a hard time with the compounding, because it sort of circumvented that a little bit.
Yeah, and pretty quickly, right?
Yeah,
Just
exactly.
as they were kind of like taking off. Thank you so much. It's been a long time. We're so
Good
glad
to
we could
see
catch up.
you.
Madison Muller, Bloomberg News health reporter. Check her out on the Bloomberg and at Bloomberg.com.
Hey, coming up next, we're talking about another area of the market, specifically distressed real estate. Amy Rubenstein over at Clear Investment Group. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg, looking at another rally in tech companies today with the Dow, the S&P, NASDAQ, the NASDAQ 100 index, and yes, Russell 2000 index of small cap shares all pushing higher. The Russell 2000 up 0.9. That compares to a 0.7% gain on the S&P, up now by 45. The S&P at 69.77. Dow on track for a record, up 48 now, gain of 0.1%. Any advance today will build on Friday's record. Right now, the Dow is at 50,164. NASDAQ 100 index up 1%. The Russell 2000 again up by 0.9%. The VIX just above 17 with the 10-year at 4.19%, the 2-year 3.48%. Spot gold up $109 the ounce to $5,073, up 2.2%. Silver up 7.2%, $83.40 for an ounce of silver, while West Texas Intermediate crude oil up 1.2%, $64.29 for WTI. And Bitcoin now up 0.3%, 70,861 on Bitcoin. Apollo Global Management shares up 1.2%. Apollo set a record in its business of making loans, a crucial plank in the firm's ambition to become one of the largest underwriters on Wall Street. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, today's Bloomberg Big Take, it's an exclusive. It's on the Bloomberg Terminal. It's on how private lenders have started the foreclosure process on 7.4% of the 2,000 properties that they financed in 2023, with initial foreclosure filing spiking 82% nationally over a 2-year period.
Yeah, it's a story that takes us to Cape Coral, a city, what was once a hot real estate market. It's gone cold due to a spike in interest rates and insurance costs. The strain in Florida's housing market, though, it demonstrates the risks of private lending, with some lenders, Carol, warning of a dangerous turn for speculators and borrowers facing significant losses on their investments.
Yeah, so it's an interesting story that takes us to a city. So we are curious to see what our next guest says, because she invests in distressed real estate. Back with us in studio is Amy Rubenstein. She is CEO of Clear Investment Group. They target real estate investments in the distressed, mid-size, or larger multifamily sector in predominantly secondary and tertiary markets nationwide. I stole that from your website, so hopefully we've got it right. And you've talked with us. Welcome back.
Thank you.
You've talked to us. It's about workforce housing. It's about what you call free market affordable. I'm just curious, though. You guys have done a lot of transactions around the United States. Stuff in Florida. Do you have projects going on? Tell us about the environment. And I'm curious if you've got anything in Cape Coral or nearby.
We don't have anything right now in Florida. We've been in Florida in the past. Something that Florida has to struggle with is rising insurance costs, and that has made it really hard for property owners and for new investors to come into that market because of insurance.
Is that why you guys are staying out?
Well, we've been staying out of coastal for a little while. We started looking back at it again because insurance started to level out, but insurance rates are incredibly high.
That's not just a Florida story. It's a California story, too.
It's all coastal right now, and fires, right?
Yeah.
You get that in California.
And we see that start to hit parts of California, like Malibu and the Malibu area. But for the most part, California real estate prices are still really, really high, even though it's challenging and expensive to insure those properties. When does that chicken come to roost?
California real estate market has always been very unique in the sense that it's an appreciation market and not a cash flow market. So it's always been a little bit tight there. But when does that stop? I don't. It's a market that seems to not follow economics.
And you don't have anything in California right now,
We
right?
used to. We started in California. That's where we were for 10 years, and we do not now. So we are very cash flow oriented.
So talk to us about the environment, what you are seeing today versus what it was 6 months ago, 12 months ago. I think it's been a few months since we last talked.
Yeah, absolutely. We're still seeing a very bifurcated economy, both in the macro economy and then also within submarkets. So what we're seeing is a bit of mean reversion right now, where markets had overgrowth are starting to cool down a little bit, starting to try to absorb all that overgrowth. And some of the markets that were more depressed, that didn't overbuild, are starting to rise. You see something like that in like Chicago or San Francisco, where now all of a sudden you see 3-4% annual increases, which is really high compared to some of the rents in the country that are starting to drop. So we are seeing a tale of two cities.
Since we last spoke to you, the Trump administration has come out with some different, I wouldn't call them policies, I'd say policy proposals to try to get housing within control for many Americans.
Sure.
Some of them target single-family homes and institutional investors. Is anything that you've heard from Washington, D.C. helping to alleviate the problem?
You know, we're hearing a little bit about it in that single family buy to rent or rent to own model. And we're not seeing it we don't hear proposals coming out as how are you going to help workforce housing or market rate housing, right? So there are ways to help as far as subsidized housing like Section 8 or something like that. But ultimately what it comes down to is cost of living is rising so much, and it's more so than the cost of actual housing. That workforce housing or free market housing stays pretty stable. It grows slowly, but it stays a little bit independent from macroeconomics because you get a lot of friction in mobility. People aren't moving a lot out of their units, but then again, we talk about this lack of affordable housing.
Right.
We have to dig into what is that? What does that mean?
Well, we constantly, I think, pepper people with questions to try to understand. And before we got going, we said, well, one of the things that we've kind of pushed on is building housing, affordable housing where the jobs are, whether it's a major city, rather than having someone who's got to, take a train or a bus or however, 2 hours or an hour and a half or something, outside that major city in order to live, affordably.
Sure. I mean, you see something like New York right now, and you've got units here that are vacant, but it's hard for landlords to bring them back online. How do they do that, especially when you've got threats of a rent freeze here in New York? How do you offset that for the landlord?
So it's cheaper for them to leave them open than to rent them at a below market rate.
That's true in some of the places in New York. New York is very specific.
Okay. But not in other cities?
In other cities, you're not seeing that as much, but you don't have those freezes like that. Even in places where you do have rent control, we are seeing some relief on other sides. I think that we do see that cities are starting to recognize that keeping landlords from raising their rents ends up hurting affordability overall.
Where are you bullish right now? Where do you want to do new projects?
We're really bullish in the Midwest right now. We like areas that are very stable. We don't like to see that overgrowth. We like to see places that are that have a lot of economic growth as far as workforce.
So where in the Midwest?
We love Ohio right now. We're buying a lot there. It's a great time to invest right now if you're very discerning and specific with what you buy. So we're looking for upside down capital stacks.
So Southern Ohio, Central Ohio, Northern Ohio. I mean, these are all very different parts.
Sure. Right now we're heavy in Columbus. We're looking in Cleveland. We're looking in Cincinnati.
Okay, so that's everywhere. Pretty much.
It's a little bit. We're all over the Midwest. We like other cities too. It really depends. We're more deal oriented. We're looking for where is that upside down capital stack that really needs us to come in to infuse capital, because that's what really happens.
So much money has gone down south, certainly the Southeast. Is that gotten overheated at this point? I've heard some signs or some stories about things like prices starting to come down, at least in kind of residential homes. But what are you seeing there?
Right. So that's that Sun Belt area or some of those overheated areas that are now coming back down. So I think that what happened is there was this oversupply of building, right? We hit this peak of building in like 2022. Those units started coming online. If you take a look at where we're at today, new development is 70% in 2025 below where it was at its peak in 2022. So now we're seeing that absorption. And so that drops prices for a little bit, but they'll even out and start to come back.
So Amy, in terms of affordability, bottom line, in your view, it's more about like thinking about why is it that people can't afford to buy homes? And is it wages, or like, is that what we need to be focusing on in your view from what you see?
Right. So in what I deal with, we are not really competing against the home market. We are providing housing for renters by necessity as opposed to lifestyle renters or people who choose. But what we're seeing is really it's cost of living is high and cost of mobility is high. And so that just getting out and packing up and moving and getting a new security deposit down somewhere, and that the costs of that is what is expensive. So we're seeing a lot more concessions on the front end as opposed to rent reductions.
All right. Well, always a great window into real estate. Thank you so much.
Thank you.
Good to see you. Amy Rubenstein, she's CEO of Clear Investment Group. When we come back, a check on the trading day and also some specific stocks on the move. This is Bloomberg.